If you sell products, inventory isn't optional. It's the backbone of your business. Yet it's one of the most overlooked areas in small business bookkeeping. Too many Etsy seller, food vendors, and tradespeople think, I'll just keep buying supplies and hope it all works out in the end. But here's the truth. Ignoring inventory can quietly destroy your profits. Think of inventory like water in a leaky bucket. You can keep pouring sales into the top, but if you don't track what's leaking out of the bottom, materials wasted, unsold items piling up, supplies forgotten in a drawer, you'll never know why your bucket never fills. Let's look at some real life scenarios. As an Etsy seller, you buy $500 worth of fabric in January. By June, half of it is still sitting untouched in a storage bin. Without tracking, you're recording $500 as an expense, but the truth is, only the fabric you turned into products and sold should count towards your cost. The rest, that's inventory, money tied up in materials. As a food vendor, you purchase $300 in ingredients for an event. After the event, $75 of food is unused and goes into the freezer for next time. If you call the full $300 an expense, your profit margin looks worse than it really is. Without separating inventory from what was actually sold, you're undercutting yourself. And as a trade person, you stock up on $1,200 worth of lumber. You only use $800 for the month's projects, and the rest sits in your shop. If you expense the full $1,200, your books show less profit than you really earned. See the pattern? Treating all purchases as immediate expenses distorts your numbers. You end up with financial statements that don't reflect reality, and that means you're making business decisions in the dark. Inventory isn't just stuff. It's cash you've already spent, waiting to become income. Tracking it gives you clarity in 3 ways. 1, pricing confidence. When you know what each product costs to make, you can price it to cover cost and leave room for profit. 2, cash flow awareness. Inventory ties up money. Knowing how much is sitting on the shelves tells you how much you can actually spend elsewhere. And 3, tax accuracy. The IRS doesn't let you expense all your supply purchases at once. They expect you to calculate cost of goods sold, or COGS, the portion of inventory actually used to make what you sold. In short, inventory tracking is not optional if you want clean books, accurate taxes, and a clear picture of your profit. Ignoring inventory doesn't just mess with your numbers. It creates stress. You've probably had moments where you dig through bins for a material you thought you had only to realize you're out. Buy duplicates because you didn't realize you already had it, or feel unsure if your prices are high enough because you're just guessing. That uncertainty eats away at your confidence. But when you have a simple inventory system, even if it's just bins, labels, and a spreadsheet, the stress disappears. You know what you have, you know what you've used, and you know what each product costs to make. Whether you're just starting out or you've been selling for years, here's the bottom line. If you sell products, you need to track inventory. Not perfectly, not in some complicated software, but you need a system, because without it, you're flying blind. And flying blind is how small businesses sink, not because they don't have sales, but because they don't have clarity. This episode is about giving you that clarity. So here's where we're headed in this episode. First, we'll clear up the confusion between supplies and inventory. Hint, the IRS cares a lot about this. Then we'll walk through simple ways to track inventory, from bins and labels to spreadsheets you can build today. Then we'll break down the cost of goods sold, or COGS, how to calculate it, why it matters, and how it ties to your taxes and pricing. And then we'll wrap up with when to level up, how to know when it's time to move beyond spreadsheets into software. By the end, you'll see inventory not as a burden, but as a tool, a way to protect your profits, calm your stress, and make smarter decisions. Because materials shouldn't sink you, they should support you. One of the biggest areas of confusion for product-based businesses is this. What's the difference between supplies and inventory? At first glance, they look the same. You buy materials, you use them, money goes out. But for bookkeeping and for taxes, there's an important distinction. Get it right and your books make sense. Get it wrong and you're either overstating your expenses or undercutting your profit. Let's clear this up in plain English. Supplies are items you use to run your business, but they don't become part of the product you sell. They support the work, but don't directly create inventory. Think packing tape and shipping boxes, printer ink for your labels, cleaning supplies for your kitchen or shop, sandpaper for finishing wood. They're real costs, but they're considered overhead, not part of the product itself. You usually expense them right away in the period you bought them. An inventory is anything you buy with the intent to turn into something you sell. It's not overhead, it's part of your product. Think fabric, beads, and thread for Etsy sellers, meat, flour, or produce for food vendors, and lumber, nails, or paint for tradespeople. Inventory isn't expensed immediately. Instead, it sits on your books as an asset until you use it to make a product. Once the product sells, part of that inventory becomes cost of goods sold, COGS. Here's why the distinction matters so much. For profit clarity, if you lump everything as supplies, your expenses look bigger than they are, and your profit looks smaller. That can make you think you're doing worse than reality. For taxes, the IRS requires businesses that make products to track inventory. That means you can't just expense all purchases as supply in the year you buy them. You must account for inventory and calculate COGS. And for pricing, if you confuse supplies with inventory, you'll underprice your products. You'll forget to include materials in your cost calculation. In other words, knowing the difference protects your profit, your pricing, and your peace of mind. As an Etsy seller, in inventory you have $100 in fabric, $25 in thread, $15 in buttons. In supplies you have $20 in packing tape and $30 in shipping boxes. The fabric, thread, and buttons are inventory because they become part of the final product. The packing tape and boxes are supplies because they help deliver the product but aren't a part of it. As a food vendor, you have inventory of $200 in chicken, $50 in rice, and $30 in spices. Your supplies are $15 in disposable gloves, $40 in foil containers, and $10 in cleaning spray. The chicken, rice, and spices are inventory because they end up in the food sold. The gloves, foil, and cleaner are supplies because they support operations. And as a tradesperson, you have inventory of $500 in lumber, $40 in nails, and $60 in paint. You have supplies of $35 in sandpaper, $50 in safety goggles, and $80 in tool maintenance items. The lumber, nails, and paint become part of the finished product. The sandpaper, goggles, and tool supplies do not. Here are common mistakes I see all the time. Lumping everything as supplies. It feels easier, but it's not accurate. Expensing inventory too early. Buying $1,000 in fabric in January doesn't mean you can expense $1,000 in January. Only the portion used in products sold that year counts. Forgetting to track packaging. Some packaging is inventory, like branded boxes you sell with candles. Some is supplies, like plain mailing envelopes. It depends on whether the customer receives it as part of the product. The IRS is very clear. If it becomes part of your product, it's inventory. If it supports your business but doesn't become part of the product, it's supplies. During audits, this is a hot spot. Agents look for whether businesses are correctly separating inventory and supplies. Misclassifying either can overstate or understate deductions, and both are red flags. The confusion usually comes from mixed-use items. Glue for a woodworking project, inventory. Glue for your office supplies, supplies. Same item, different classification based on use. The key is context. Always ask, did this item become part of what I sold? When in doubt, run this quick filter. 1. Does the customer take it home with the product? If yes, it's inventory. If no, it's supplies. Would I still buy this if I weren't making products? If yes, it's supplies. If no, it's inventory. That simple 2-step test will keep you out of trouble 90% of the time. Separating supplies from inventory isn't just about compliance. It protects your decision making. You know how much money is tied up in unsold inventory. You know how much overhead it really takes to run your business, and you can spot when supply costs are creeping too high. It's not busy work, it's clarity. Here's the takeaway. Supplies are used to run your business but not sold as part of your product. Inventory are materials you turn into products to sell. The IRS cares, and your profit depends on it. Get this right, and your books will tell the truth. Get it wrong, and your numbers lie. Up next, we'll get practical. We'll walk through some simple ways to track inventory, from spreadsheets you can build today to physical systems like bins and labels that keep materials from sinking your business. We've talked about why inventory matters and how to separate it from supplies. Now it's time to get practical. How do you actually track inventory without losing your mind? Here's the good news. You don't need an MBA or a $200 a month software subscription. For most Etsy seller, food vendors, and tradespeople, a combination of spreadsheets, bins, and labels will get the job done. The key is building a system that's dummy-proof, repeatable, and tailored to how you work. Before we dive into the how, let's remind ourselves of the why. Inventory tracking gives you clarity on what you have on hand, control over spending, so no more buying duplicates, accuracy for calculating cost of goods sold, and confidence at tax time so you can prove your numbers. Skipping tracking may feel easier short term, but it creates long term chaos. A few minutes of tracking each week saves hours of confusion later. Method 1. Spreadsheets. A spreadsheet is the simplest, cheapest, and most flexible way to track inventory. Excel or Google Sheets both work. Step 1 is build a table. Here are the columns you need at minimum: item name, description, quantity purchased, unit cost, total cost, quantity used or sold, and quantity remaining. Step 2, update it regularly. Every time you buy materials, add them to the sheet. Every time you use materials for a product, subtract them. Step 3, add formulas. Total cost equals quantity purchased times unit cost. Quantity remaining equals quantity purchased minus quantity used. This keeps everything current without too much manual math. And a pro tip, color code items low in stock with conditional formatting. For example, if lumber drops below 10 boards, the cell turns red. Method 2, bins and labels. Numbers are great, but sometimes you need a physical system to match the spreadsheet. That's where bins and labels come in. The bin system. Assign each material its own bin or shelf space. Label clearly fabric, blue cotton, 2 yards, or spices, cumin. Match the labels to your spreadsheet item names. This way, when you update the spreadsheet, you can double check physically. Why it works? It prevents duplication. You can see what you already have. It saves time so you're not digging through piles, and it makes counting easy. Just open the bin and tally. Method 3, labeling finished goods. If you make products in batches, label them too. For example, an Etsy seller, candle batch number 42, March 2025. For a food vendor, barbecue sauce batch number 15, used by April 30th. For a tradesperson, table number 7, walnut, finished April 2025. Batch labels let you track which materials went into which product and help with quality control. Method 4, tracking by category. Some businesses don't need to track every screw or pinch of salt. Instead, track by category. Examples: for Etsy, track fabric, cotton instead of every single pattern. For a food vendor, track dry spices as a group. For a tradesperson, track hardware as a bucket for nails and screws. The key is to be detailed enough to calculate costs, but not so detailed that you overwhelm yourself. So let's put it all together. As an Etsy seller, your workflow might look like this. You buy $100 of fabric, you add it to the spreadsheet, and put fabric in a labeled bin. When cutting fabric for products, subtract the yardage from the spreadsheet. Label the finished item, and at month end, review the spreadsheet to see what's left. For a food vendor, your workflow might look like this. You buy bulk ingredients at Restaurant Depot and you log them into the spreadsheet. You store them in bins labeled by type. After each event, subtract what was used and note leftovers. Freeze or store leftover inventory and carry it forward. And as a tradesperson, your workflow might look like this. You buy 30 boards of lumber and you log it into the spreadsheet. You store it in a rack labeled 2x4x8. For each project, subtract boards used. Label finished projects with project name or customer. Review your spreadsheet weekly to restock. Now here are some common pitfalls and how to avoid them. Forgetting to update. Build a habit. Log purchases and usage immediately, or set a weekly check-in. Overcomplicating categories. Don't try to track 50 fabric patterns separately if you only need cotton fabric totals. Not linking to COGS. Remember, inventory isn't just for storage, it's for calculating cost of goods sold. We'll cover that in the next section. Not labeling bins. A spreadsheet without physical organization equals chaos. And there are tools to make tracking easier. Barcode scanners. A cheap USB scanner lets you assign barcodes to bins or products for quick updates. An app such as Sortly, Airtable, or Craftybase. And Google Sheets plus a phone app, update on the go while in the shop or at events. Again, don't overcomplicate. The tool matters less than the habit. And inventory tracking fails when it's too complex. If you're dreading the system, you won't use it. Start simple. One spreadsheet, a set of bins with labels, a weekly 15-minute review. That's it. That's enough to keep you clear, compliant, and confident. So to wrap up this section, inventory tracking doesn't need to be intimidating. Whether it's a spreadsheet with simple formulas, bins and labels that keep your shop organized, or categories that keep things streamlined, the goal is the same: clarity, knowing what you have, what you've used, and what it costs. Up next, we'll tackle the heart of it all: how to calculate cost of goods sold. This is where your inventory records turn into financial clarity and where many small businesses either shine or sink. Now that you've got a grip on tracking your inventory, let's talk about the next step: turning that tracking into meaningful numbers. This is where cost of goods sold, or COGS, comes in. COGS is the financial bridge between your materials and your profit. It answers the question, how much did it cost me to make the products I actually sold this year or this month? Without it, you're just guessing. With it, you know your true profit margin. Here's the COGS formula in its simplest form. Beginning inventory plus purchases minus ending inventory equal COGS. Let's break that down. Beginning inventory, what you already had on hand at the start of the year or month. Purchases, the cost of new materials you bought during the period. And ending inventory, what you still have on hand at the end of the year or month. Add beginning inventory and purchases, then subtract ending inventory. The result is the cost of what you actually used to make products you sold. Say you're an Etsy seller making candles. Your beginning inventory is $300 worth of wax and wicks from last year. You purchased $700 worth of supplies this year. Your ending inventory is $200 worth of supplies left unused. So you plug it in. 300 plus 700 minus 200 equals 800. That $800 is your cost of goods sold. It represents the cost of the supplies that turned into products sold. So why does this matter? COGS is critical because it determines your profit. Revenue minus COGS equals gross profit. Impacts your taxes. The IRS requires product-based businesses to calculate COGS. You can't just expense everything you bought. It guides your pricing. If you don't know your COGS, you might price too low and lose money without realizing it. In short, COGS keeps you honest about your numbers. If you're a food vendor, here's an example. Your beginning inventory was $100 worth of frozen chicken. You purchased $500 in ingredients for events, and your ending inventory is $75 left in the freezer. So your COGS equals 100 plus 500 minus 75, which is $525. That $525 is the true cost of ingredients sold, not the full $600 you spent. And as a trade person, your beginning inventory is $400 in lumber. You purchased $1,200 in lumber during the year, and your ending inventory is $300 left unused. Your COGS is 400 plus 1,200 minus 300, which equals 1,300. That's the cost of lumber actually used in sold projects. Now we're going to go over some common mistakes. Mistake number 1, expensing all purchases immediately. If you spent $1,000 on fabric in January, you can't call all $1,000 an expense unless you used it all. Anything left in inventory at year-end stays as an asset until sold. Mistake number 2, forgetting beginning inventory. Your starting materials matter. Ignoring them means you understate your cost of goods sold. Mistake number 3, not counting ending inventory. If you don't measure what's left, you'll overstate cost of goods sold. That makes your profit look smaller and could cost you deductions later. Mistake number 4, mixing supplies and inventory. Packing tape and printer ink don't belong in cost of goods sold. Only materials that become part of the product count. So how to calculate COGS step by step. 1, take a count at the beginning of the year. Record what you have and its value. 2, track purchases. Keep receipts and add them to your inventory log. 3, take a count at the end of the year. Record what's left. 4, apply the formula. Beginning plus purchases minus ending equals COGS. And cost of goods sold doesn't just help with taxes. It tells you if your prices make sense. Say you sell a handmade necklace for $40. If your cost of goods sold for each necklace is $15, your gross profit is $25. If you're selling it for $40 but your cost of goods sold is $35, you're only making $5 before overhead. That's not sustainable. Without tracking cost of goods sold, you never know. Here's the key IRS rule. If you produce or sell physical products, you must account for inventory and calculate cost of goods sold. That means you can't just expense everything when purchased. You must track beginning and ending inventory. You must report cost of goods sold on your tax return, which is Schedule C for sole proprietors. Skipping this isn't just sloppy, it risks non-compliance. I once worked with a small bakery that bought $20,000 worth of ingredients in a year. They expensed all $20,000. But when we did the inventory, $5,000 worth of flour, sugar, and supplies were still on the shelves. Their actual cost of goods sold was $15,000. By misclassifying, they were understating profit and potentially raising IRS red flags. Once corrected, their books told the truth. So how often should you calculate cost of goods sold? For taxes, at minimum, once a year, beginning and end. For clarity, quarterly or even monthly helps you see your profit trends sooner. If you're growing quickly, more frequent cost of goods sold calculations help you adjust pricing before it's too late. Here's how to use a spreadsheet for cost of goods sold. In tab 1, have a purchases log, date, vendor, amount, item, category. Tab 2, beginning and ending inventory counts. And in tab 3, cost of goods sold calculation using the formula. This ties your records together so you always know your cost. Cost of goods sold isn't complicated, but it is critical. Remember the formula. Beginning inventory plus purchases minus ending inventory equals cost of goods sold. That number tells you the true cost of making what you sold. It protects your pricing, clarifies your profit, and keeps you compliant with the IRS. Without it, you're just guessing. With it, you're running your business with clarity and control. By now you know you can track inventory with a spreadsheet and some labeled bins. For many small businesses, that's more than enough. But there comes a point where spreadsheets start to feel like duct tape holding everything together. The bigger you grow, the more moving parts you juggle, and the more valuable it becomes to level up into dedicated tools. So how do you know when it's time to move beyond bins and Excel? Let's walk through the signs. Sign number 1, your spreadsheet is overwhelmed. A simple spreadsheet works fine when you're tracking 20 to 30 items, but if you're juggling dozens of fabric types, hundreds of SKUs, or multiple purchase and sales channels, you'll quickly hit a wall. The more complicated your inventory becomes, the more prone your spreadsheet is to errors, and every manual update is another chance for mistakes. If you're spending more time fighting formulas than making products, it's time to level up. Sign number 2, you can't keep up with sales platforms. Maybe you started on Etsy, then you added Shopify, then you started selling at crafts fairs. Suddenly one product sells in multiple places and your spreadsheet can't keep up. Did you sell 3 candles on Etsy and forget to subtract them from the Shopify stock? Did you oversell because you didn't update it in time? Did you miss a restock alert? When you're selling in multiple places, software that syncs across platforms prevents mistakes and embarrassment. Sign number 3, you're losing track of cost. Cost of goods sold is simple when you only have a few items, but as your catalog grows, tracking exact material usage per product gets messy. Example, you buy a 50-pound bag of flour. How many cupcakes does that really make? Or you buy 200 yards of fabric. How many dresses does it cover? If you're struggling to tie raw materials directly to finished products, software can automate the math. It keeps your cost accurate without hours of spreadsheet wrangling. And sign number 4, you're spending more time tracking than selling. Your inventory system should serve you, not the other way around. If you're spending hours each week updating spreadsheets, counting bins, and reconciling numbers, you're burning time you could spend on sales or product development. Leveling up to a system that automates updates, saves time, and reduces stress. So when you're ready to level up, here are some tools to consider. Craftybase. It's designed specifically for makers and Etsy sellers. It tracks raw material, finished goods, and cost of goods sold. It syncs with Etsy, Shopify, and other platforms, and it's great for handmade businesses that need real detail on cost. QuickBooks Online. It's not just bookkeeping, it does have inventory features. It's good if you're already using QuickBooks for accounting, and it syncs with sales channels, but it can be more complex. Square for retail. Strong if you do in-person sales such as craft fairs or farmers markets, and it tracks stocks across locations. And it has an easy point of sale integration. Airtable or Sortly. They're more flexible and less accounting heavy, and they're good for visual thinkers who want drag and drop style management. Leveling up isn't about getting fancy. It's about recognizing when your time and accuracy are too valuable to risk on manual methods. Spreadsheets are great for lean businesses. Software is great for scaling businesses. Neither is better. It's about what stage you're in. So how do you transition smoothly? Start with clean data. Make sure your current spreadsheet is accurate before migrating. Pick one tool and commit. Don't bounce between 5 apps. Run parallel for a month. Track both your spreadsheet and the new tool to ensure accuracy. And then fully transition. Once you trust the system, let it take over. Here's the bottom line. You don't have to level up until your current system stops working. But when you're overwhelmed, overselling, or losing hours to tracking, that's your cue. At that point, investing in the right tool isn't an expense. It's protection for your profits and your sanity. Because at the end of the day, inventory isn't just about materials. It's about making sure your system grows with your business. We started this episode by saying inventory can sink your business if you ignore it. Now you know why. Inventory isn't just a pile of materials in your shop, kitchen, or garage. It's money you've already spent. And if you don't track it, you'll never truly know your cost, your profits, or your pricing. Here's what we covered today. Why inventory matters. It's not clutter, it's cash tied up in materials. Tracking it protects your profit. Supplies versus inventory. Supplies support your business. Inventory becomes part of what you sell. The IRS cares about this distinction, and so should you. Simple tracking methods. Spreadsheets, bins, and labels are enough to keep most small businesses on track. Cost of goods sold. Beginning plus purchases minus ending equals what it really cost you to make what you sold. And when to level up. Spreadsheets are fine until they're not. At scale, tools like Craftybase, QuickBooks, or Square keep you from drowning in details. So here's your practical takeaway. Decide how you'll track. Start simple, a spreadsheet and bins with labels. Separate supplies from inventory. Run everything through the 2-question test. Does it become part of the product? Would I buy it if I weren't making products? Calculate your cost of goods sold. Even if you only do it once this year, do it. Beginning plus purchases minus ending. That number is the truth about your cost. And check in regularly. Make inventory review a monthly or quarterly routine. That's all you need to stay in control. If you're a detail-oriented person who likes having your hands on the numbers, spreadsheets will serve you well. They're flexible, free, and perfectly fine for businesses under 200 transactions per month. If you're listening and thinking, this is too much, I'll never keep up, take a breath. Start with the next step, not the whole staircase. Label a bin, open a spreadsheet, write down what you bought today. And if that backlog feels impossible, that's where Zero Fluff Books comes in. We help small businesses clean up their books, organize their inventory, and calculate cost of goods sold so you can stop guessing and start growing. When you track inventory and calculate cost of goods sold, you gain clarity on what's really driving your cost, confidence in your pricing, control over your profit margins, and calm at tax time so you can prove your numbers. Inventory isn't glamorous. It's not what you post on Instagram, but it's the difference between running a hobby and running a business. So don't let materials sink you. Track them, organize them, use them wisely. Because when you control your inventory, you control your profit. Clean books, less stress, zero fluff.